Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Xinyi Solar Holdings Limited annual report. Xinyi Solar Holdings Limited offers a diverse range of businesses and services across various regions globally. The company operates through two main segments: sales of solar glass and solar farm business. In the sales of solar glass segment, Xinyi Solar produces and sells solar glass products such as ultraclear patterned solar glasses, back glasses, and antireflective coating solar glasses to international markets in mainland China, rest of Asia, North America, Europe, and other regions. These products are essential components for solar panels. In addition to solar glass sales, the company also engages in the development, operation, and management of solar farms, generating solar power through these facilities. Furthermore, Xinyi Solar offers engineering, procurement, and construction services, as well as solar power systems and silicon products. The company's business scope extends beyond renewable energy solutions, with mining activities and the sale of mining products also being part of its operations. This diversification enables Xinyi Solar to tap into multiple revenue streams and expand its market presence globally. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop. The stock price of Xinyi Solar has dropped slightly over the past year due to various market and industry factors. One possible reason is the decline in demand for solar panels globally. As governments implement policies to reduce carbon emissions and transition to renewable energy, the pace of adoption may slow down, leading to a decrease in sales and revenue for companies like Xinyi Solar. Another factor that could have contributed to the drop in stock price is increased competition from other solar panel manufacturers. The solar industry has become increasingly competitive, with many new players entering the market. This increased competition can lead to lower prices, reduced profit margins, and a decrease in stock value. Additionally, changes in government policies or regulations can also impact the stock price of Xinyi Solar. For instance, if there are any changes to tax credits or incentives for solar panel installations, it could affect demand and revenue for companies like Xinyi Solar. Lastly, macroeconomic factors such as inflation, interest rates, and currency fluctuations can also influence the stock price of Xinyi Solar. A strong dollar, for example, can make exports more expensive, reducing demand and profitability for companies with significant export sales. In conclusion, a combination of market, industry, and economic factors may have contributed to the slight drop in Xinyi Solar's stock price over the past year. The Xinyi Solar Holdings Limited market capitalization of $30 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Xinyi Solar Holdings Limited holds a significant advantage in their industry. Xinyi Solar Holdings Limited trades at a higher price-to-book ratio of 0.87 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified by examining the key factors that have influenced the company's financial performance. Revenue decline is primarily driven by a combination of factors, including a decrease in sales volume, particularly in the solar glass business, which saw a decline of 9.1%. Additionally, the renewable energy segment experienced a decline in sales, with a 33% drop in solar glass sales and a 28% increase in electricity sales, indicating a shift in market demand. Furthermore, the global PV installation growth slowed down, leading to a decrease in revenue. On the other hand, revenue growth is driven by several factors, including an increase in sales volume, particularly in the renewable energy segment and interenergy business segment. The company also saw additions to non-current assets in the renewable energy segment, which contributed to revenue growth. Additionally, customer-specific revenue increases, such as those experienced by Customer A and Customer C, also played a significant role. Scrap sales and government grants further contributed to revenue growth. The financial performance of a company has been subject to varying interpretations. Initially, the net income was reported to have decreased by 16.2%. However, this figure is contradicted by other sources, which suggest that it remained relatively stable or even increased by $131.8 million. A closer look at profit margins reveals mixed results as well. On one hand, fixed asset impairment and market-oriented reforms had a negative impact on the company's profitability. Additionally, impairment provisions further constrained its profit margins. Nevertheless, there was an improvement in the solar glass segment, which contributed positively to the overall profit margins. Despite these contradictory reports, it is evident that the net income and profit margins underwent significant changes. The exact nature of these changes remains unclear due to conflicting information provided by different sources. Based on the provided information, it is clear that the company is indeed generating positive operating cash flow. This is evident from the financial data presented on page 44, which states that the net cash generated from operating activities reached a significant amount of RMB 5,656.2 million in FY 2025. This achievement indicates that the company's operations are profitable and capable of producing sufficient cash to cover its expenses and investments. The positive operating cash flow is a crucial indicator of a company's financial health, as it allows for reinvestment in the business, debt repayment, and distribution of dividends to shareholders. The company's debt level and interest expenses have undergone significant changes in recent periods. While the total borrowings increased by approximately RMB 528,221, or 4.6%, this growth is largely driven by a 25.7% increase in non-current borrowings. Conversely, current borrowings decreased by 15.8%. The issuance of fixed-rate bonds with a 2.1% annual coupon rate may lead to an increase in interest expenses. However, the finance costs have actually decreased by RMB 167,890, and the interest expense has also seen a decline from RMB 75.5 million to RMB 56 million. The performance of various segments and regions within the company has been mixed, reflecting both successes and challenges. The renewable segment stood out as a strong performer, boasting high gross profits on pages 9 and 10. In contrast, the interenergy business segment lagged behind its renewable counterpart. Geographically, mainland China was a standout, with revenue reaching RMB 14,428,432 on page 10. This performance eclipsed that of North America and Europe, which saw significantly lower revenues of RMB 660,717. The others category also struggled to match the success of mainland China. In terms of specific segments, the solar glass segment experienced a decline in revenue of 5.3% from the previous year on page 37, although its gross margin improved. Meanwhile, the renewable energy segment reported relatively stable revenues with a slight decrease in gross profit on the same page. Management's outlook on the company's strategy suggests a cautious approach in the face of industry challenges. Despite potential volatility in solar installations, the company has shifted its focus from scale expansion to refined operations. This change is driven by regional disparities in policy orientation, grid absorption capacity, and solar resources. As a result, the target for new grid-connected capacity will remain low at approximately 100 MW per year, significantly lower than the historical average of 500 MW per year. The suspended construction of new solar farm projects due to policy changes in China has also impacted the company's renewable energy strategy. Overall, management is adopting a more conservative approach to navigate the uncertain industry landscape. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has taken a significant step by acquiring a wind farm project with an approved power generation capacity of 64 MW. Additionally, it has acquired a 51% equity stake in Tianjin Solar Farm project from Xinyi Energy Group. On the other hand, the company has also made some divestitures to streamline its operations and focus on core business areas. Specifically, it has suspended 2 solar glass production lines in China with a total daily melting capacity of 18,000 tons. Furthermore, the company has sold 3 solar farm projects with an aggregate capacity of 230 MW to Xinyi Energy Group. These acquisitions and divestitures demonstrate the company's efforts to optimize its portfolio and adapt to changing market conditions. By acquiring new assets and divesting non-core businesses, the company is positioning itself for future growth and success. The company's financial history reveals a consistent trend of paying dividends to its shareholders. This practice, as noted on page 19 and page 27, demonstrates the company's commitment to rewarding its investors through cash distributions. In contrast, there is no evidence to suggest that the company has engaged in share buybacks, indicating that it has not repurchased any shares from the market. Concerns about inventory buildup and supply chain disruption are emerging in the industry. Inventory levels have been increasing, with mentions on page 35 of potential issues and page 44 highlighting a reduction in inventory levels as a result of slower expansion. This buildup can lead to working capital being tied up. Supply chain disruptions are also a concern, driven by escalating geopolitical tensions and rising trade barriers, page 31. Additionally, global PV installation growth slowdowns, supply-demand imbalances, and reduced production have been noted on page 38. The industry is currently in an adjustment phase due to overcapacity, as mentioned on page 47. These issues highlight the need for careful management of inventory levels and supply chain resilience to mitigate potential disruptions. That concludes the financial summary for Xinyi Solar Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.